Welcome, everyone. My name is Bill Harris, CEO here at BIP Wealth, and we have a nice presentation, Understanding the New Tax Law. And we have Sarah Watchko, who is our estate planning attorney, Allie Powell, who is our tax professional. She's our CPA. Sarah joined us just over a year ago from her own firm where she did practiced her estate planning as a professional. And then you had Allie, who joined us from one of the top CPA firms here in the Southeast. So we'll go ahead and turn it over to Sarah and Allie and let them take it from here with understanding the new tax laws. Thank you.
Thank you, Bill. And thank you, everyone who is here spending your lunch hour with us. I'm very excited to be talking about taxes and planning with you all. So like Bill said, I joined BIP last year. Allie joined the beginning of this year. And so we were very excited to have our little self-proclaimed department here at BIP. When we were putting this webinar together, we were joking that we should be the death and taxes department, like nothing certain but death and taxes. And I realized, I was kind of embarrassed. I realized I didn't remember who originally coined that phrase. So ChatGPT helped me. Asterisk caveat, please don't use ChatGPT for your legal or tax planning. Hopefully it was right here, said that it was Benjamin Franklin in a letter to Jean-Baptiste Leroy in 1789, who said, "Our new Constitution is now established and has an appearance that promises permanency. But in this world, nothing can be said to be certain except death and taxes." So that's what Allie and I call job security. I also kind of focused in when I was reviewing this on this phrase, the appearance that promises permanency, which I think is relevant to our conversation today too. You'll notice with a number of the provisions in the new tax law, we'll talk about things that were made permanent, but it may be more accurate to say they have the appearance of permanency, because while death and taxes may be certain, how those taxes are imposed often aren't, and things that are permanent change with new administrations and new majorities in Congress. Quick bit of housekeeping here before we dive in. We structured this presentation, this webinar, to be a very high-level overview of some of the important aspects of the new tax law. It's intended for general informational purposes. It is not intended to constitute tax, legal, or investment advice. So if you need or want tax, legal, or investment advice, please consult your personal tax professional, estate planning attorney before making any decisions. We will welcome questions at the end, so please submit them. There's a mechanism for doing so. Kind of the same rule applies. We can provide assistance for more generalized questions. If there's anything specific that you want to ask about your particular situation, please reach out to your wealth advisor. They can bring Allie or myself in as appropriate. We can meet, review, have a Zoom call. That's what we're here for, and then hand off to individual professionals if that makes sense. In terms of the kind of structure of the presentation today, this new tax law, I think the final version was somewhere around 1,000 pages. I love to read. I'm a voracious reader. I know Allie is a big reader too, but we did not read the tax bill cover to cover. And we think it would be cruel and unusual punishment, maybe torture, to make you sit through or ask you to sit through a presentation on all of it. So what we have done is we've pulled out those parts of the new law that we think are most relevant and will be most impactful to our BIP clients, and broken it down in this particular way. So what we do want to focus on and discuss are really two different kinds of taxes. So first is the federal gift and estate tax. This is where I work. This is my playground. I also like to refer to it as transfer taxes. So with the federal gift and estate tax, we're talking about typically the transfer of wealth from one person to another and how a tax is or is not imposed there. After we do that, we'll transition to Allie and go over income taxes, which is where she works in place. In all of these constructs, we want to talk about, one, what didn't change. Another way of saying that is what maybe changed before this new act and was now made permanent. New parts of the tax bill, things that did change, and then kind of generally the potential impact that these changes might have. A quick note on terminology. We're going to reference the 2017 Tax Cuts and Jobs Act, which we'll often call in practice the TCJA because that's less of a mouthful. The 2017 Tax Cuts and Jobs Act introduced a lot of significant changes that were relevant in this year's bill because it made them permanent or not. It did away with them. So there's kind of a link here between what happened then and what we're talking about today. So the new tax law that we'll focus on today, we'll often just refer to it as the new tax law because that's what it is. The technical name is the One Big Beautiful Bill Act. Again, a bit of a mouthful as most of our titles are. I started calling it OB3. This is me. This is what I thought sounded easy. OBBBBBBA is a little too hard to keep up with all the B's. ABBA sounded a little bit funny. So some colleagues and I coined OB3. I just did a quick Google search and apparently other people are also calling it OB3. So I'm pleased to learn that KPMG had an article about OB3. So good news. It's not just me. So talking about the federal gift and estate tax, or again, what I like to call the transfer tax, we want to break it down into what didn't change and what did. On the what didn't change, really the core elements and structure of the transfer tax system that we have here in the United States did not change. Note that some states, individual states, have their own gift or estate tax or inheritance tax, but it's the minority of states, and Georgia is not one of them. So everything we're talking about today is at the federal level. So a few core concepts as it relates to the transfer tax that have not changed. One is that there's an exemption. There's an exemption amount where until you've given away that dollar amount during your life, or if not, upon your death, no transfer tax applies until you've exceeded that exemption. Spoiler alert, the exemption amount is what changed, but not the fact that there is a set exemption. There's another really important concept called the marital deduction. What that means is spouses, U.S. citizen spouses, can leave an unlimited amount to each other or give an unlimited amount to each other without any transfer tax applying. So if I have $1 billion, sadly I do not, but if I have $1 billion, I can leave that to Jeff in my will. Jeff's my husband. I can gift that to Jeff during my life, and there's no transfer tax imposed. And it doesn't use up any of my exemption amount. If my exemption amount is 15 million, for example, I haven't used any of that. So that's a really important part of our planning, and that's still the same. Another really important concept that survived the new tax law and remains intact is called portability. So again, if I leave my $1 billion to Jeff when I pass away, he gets $1 billion. I didn't have to use up any of my exemption amount because we're married and we fall under the marital deduction. So he can choose to port it over to him and take it with him. So my $15 million, under portability, he can take it with him. What that means kind of impact-wise is that a married couple can combine their two estate exemptions, either gifts during life or at death. We really think of it as a married couple kind of has 30 million if an individual has 15. Another transfer tax concept that remains is the annual exclusion. So I think of the annual exclusion as the IRS doesn't want to keep up with my birthday presents and my Christmas presents and my Hanukkah presents. There's some floor or some de minimis amount where under that, we don't have to report it. The IRS doesn't want to know about it. 2025, this year, the annual exclusion is $19,000. So anything under that floor of $19,000, I can just give and give. I can give 19,000 to 20 different recipients, 100 different recipients, don't have to file anything, no taxes imposed. Anything over the floor, the annual exclusion, has to be reported, but there's no tax due until we get to the exemption amount and go over it. So above the floor, below the exemption, we have to file a gift tax return. We're chipping away at our lifetime exemption or allowance, but there's no tax due. And I've heard that as kind of a common misconception, like, oh, if we're over the annual exclusion amount, we have to pay gift taxes. No, not unless and until during your life, you've used up all of your exemption or all of your allowance. So all of that remains the same. The big change in the new tax law was what the exemption is. And again, I've already referenced this several times. We got a permanent, the appearance of permanence, federal gift and estate tax exemption of $15 million per person. So for a couple, we can think of that as $30 million effective 1st of 2026. So this is relevant in part, or the importance of this, I would say, makes a lot more sense when we look at kind of the past, the history of the federal estate tax exemption, and where we've been and where we might be going. And that will be on our next slide. There we go. Thank you. So this chart represents where the federal estate gift and estate tax exemption, I say both because it's unified. Like you have one exemption that you can use during your life, whether it's making gifts or whether it's leaving things under your will. It's one unified exemption amount or allowance. So if we look back to 2001, I was graduating from high school. I think the Arizona Diamondbacks won the World Series, and the estate tax exemption was $675,000. So that means that any dollar transferred during life or at death over that amount was subject to the federal transfer tax system. Now we have a flat rate. So now anything over is 40%. Back then it was I don't know if it's the right terminology, a graduated rate. So if you had over $10 million, it was 60%. I mean, you would get up to a 60% bracket. That's obviously significant. Also, when you think of how many families were impacted by this estate tax, like so many families, it really drove a lot of the planning because so many were impacted. Well, through the years, we've had new laws, and that number has gradually gone up. So in 2008, it was bumped up. It was $2 million. So still impacting a lot of people, a lot of families, life insurance, everything you own. This is what this number is reflecting. Anything over that you transfer is subject to the estate tax. So 2008, we get this new number, but it's kind of an asterisk on the law. They say $2 million, it's going to go up. It's going to go up each year, but then it's going to sunset. It's going to expire and go back to 1 million. Before that happened, in 2010, there was an unlimited exemption. In other words, there was no estate tax. So we're at 675, we go up to 2 million, we're going up. 2010, no estate tax. George Steinbrenner passed away in 2010. His estate was purported to be over $1 billion that apparently passed to his heirs, whatever was in his estate, free of the estate tax. So, great estate tax planning advice would have been to pass away in 2010, but that ship has sailed, so now we have to do other things. So 2010, there's no estate tax, and no one knows what's going to happen. I was just kind of launching my career, so I didn't fall into this, but estate planning attorneys were really busy because everyone was trying to get their money out of their estate while they could before it dropped back to $1 million exemption. It wasn't until December 17th, 2010, President Obama signed into law the new tax bill that set it at $5 million. Big leap. And this was kind of the beginning of the shift to a higher and higher estate tax exemption. So 5 million becomes the number, it adjusts for inflation. So all of a sudden we're seeing, families, individuals aren't facing estate tax issues until they're at 5 million plus. Couples aren't facing estate tax issues until they're at 10 million plus. Then in 2017, the TCJA we referenced passes and we get to 10 million per person adjusted for inflation. So it keeps getting higher and higher. Fewer and fewer families are exposed to the estate tax. And then by 2025, this year, with our inflation adjustments, we're at 13.99 million, higher and higher. But the TC and GA had that sunset asterisk. The TCGA, this part of it was set to expire. So at the end of this year, we would have gone from almost 14 million per person down to 7 million per person. So there are a lot of people in that range where they're going, I don't know, I'm going to have an estate tax problem. I might be fine if it's 14 or 15 or 28 or 30, but not so much if it's 7. So July 4th, 2025, OB3 is signed, becomes law. Effective January 1st, 2026, we're at 15 million. And the big deal here too is that, first of all, it's a really high number. But second of all, it's permanent. It has the appearance of permanence. It's permanent until it's not anymore, until a future Congress or and administration, do something different. But at least we have a lot more certainty than we've had, throughout most of my career. So that's a lot of numbers and graphs, but what does that mean? How does that impact us? One way to think about it, and one perspective that I have, is when you look back over the years, it wasn't that terribly long ago that the estate tax exemption was a third of what it is now. It wasn't that long ago that I was graduating from high school and it was $600,000 some dollars. The way that we did estate planning when the exemption was much lower, and the way that we do planning when you're exposed to the estate tax, involves a lot of really complicated structures and trusts, and it's really tax driven. What that means is that these plans grow stale if we don't update them. If my plan was drafted in contemplation of a much lower exemption amount, I may not need that complication anymore. It may not make sense. And worse, there may be a downside. There may be an income tax planning downside, for example. So there are a million reasons that we should review and update our estate plans, but that's a really big one. The older it is, the less likely it's not going to gel with the current transfer tax system. Another perspective is kind of thinking more of in the present day, what changed between July 1st, 2025 and July 5th, 2025, the day after this new law passed or was enacted. For our smaller estates, our estates that are nowhere close, or we don't expect to be anywhere close anytime soon to reaching any of these thresholds, it's really, stay on the same course. Our strategies remain unchanged. Good news, bad news, the Watchko family didn't have an estate tax problem if it was going to be 7 million or 14 million. I have Ross Hughes working on that, but we're not there yet. So if you're in that, smaller estate range, it's really business as usual. And on the flip side of that, our very high net worth estates, we kind of think of that as you would have had a problem either way. A good problem, really good news, bad news, but you would have been over 15 or over 30 for a couple. The strategies, the components of your plan really aren't going to change because of this new permanent exemption amount. And then we think of those that are in between. There are a number of families who, if it stayed high, if the exemption stayed high, wouldn't be exposed, but could have been if it dropped down low. And so there, we think of there we're safer now. We may not need to contemplate aggressive tax planning like lifetime gifting or more complicated trust planning than we would have if it had dropped back. Caveat to this is that we're looking towards the future. So it's not just a moment in time. What is the size of my estate and what is the estate tax exemption today? It's where am I going to end up? Where does my financial plan put me? And so, that's, again, part of the point of us being here is that we want to keep our eyes on that, on our clients as they approach that kind of taxability or potential taxability range and make sure they've got the right tools in place. The last comment I'll make about all of this is really significantly in the past 20 or 25 years, there's just been a sea change in what really drives the estate planning conversation. It used to be so tax driven because it was such a heavy tax that affected so many people. The fewer people it impacts, the more room we have to have other conversations. Sometimes it's income tax planning, making sure there's a step up in basis when an individual passes away. Sometimes there are new strategies I'm hearing about now that we're learning about that are income tax liability shifting through the use of trusted devices. We talk a lot about asset protection. So if I want to leave assets to my spouse, which I do, how can I be sure they're protected? What if he remarries? What does that look like? I want to leave assets to my kids. What if there's a divorce? What if I want to make sure my grandkids get it? What if they're in a high liability profession and I want to make sure there's liability protection or there's an accident or something like that? So because they say, don't let the tax tail wag the dog, I think it's the saying, because Allie nods, that is the saying, good. Because we don't have, that driving force as much anymore, it's actually, it's been really, really neat in my career to see this develop into a more kind of holistic planning conversation. And that's all I have to say about the estate tax, transfer tax for now. So I'm going to kick it over to Allie to talk about income taxes.
Thanks, Sarah. That was really insightful. Hey, guys. I'm Allie Powell. I'm the tax advisor here at BIP. Almost been here 8 months now, which is crazy. I know I've met with a lot of y'all and reviewed tax returns and done some other tax items. For those who I haven't met, I look forward to working with y'all in the future. As Sarah mentioned, this act, the Big Beautiful Bill Act, or OB3, was over 1,000 pages long. So obviously we can't hit every nitpicky item in that bill. So we've just selected some items that we thought would be most pertinent to you as our clients. So a couple of items there. We can't answer specific tax questions about your situation. So if you have any questions, reach out to your personal wealth advisor and get a meeting set up. The other note I wanted to add was that this bill was pushed through by Congress. Congress is not the IRS. So what happens is once this bill got signed into law, now it kicks over to the IRS and their job is to actually put it into action. So we're still waiting to see, they'll issue some guidance and then they'll also prepare the 2025 and 2026 tax forms. And once we see the forms, we'll have good clarity of where all these items are going to go on the tax return and how it's exactly going to affect the tax situation. Right now, we have a pretty good idea. Our software that we use internally for tax projections and reviews has updated with their best interpretation of the law, but to get down to the exact numbers, we won't know until we see that IRS guidance. So where we're going to start is what didn't change. As you can recall what Sarah said, the TCJA, which was the 2017 tax change, that was the largest change we had seen since 1986. We went over 30 years without major tax reform. The issue with the 2017 law was that it was set to sunset at the end of 2025. So we didn't know what was going to happen. So either it was going to expire and everything was going to revert back to that 1986 law, or they were going to need to put a permanent bill in place. So that's what they did. They pushed through. So now we have more clarity of what 2025 going forward is going to look like. So we're going to go through some individual topics, and then at the end, we're going to cover a couple of business items, but this is mostly going to focus on individual taxes. The big one I've heard the most about both here at BIP and just with friends and family is the confusion around Social Security benefits. As you may recall watching the news, there were several iterations of this bill. There was a lot of news coverage and there was some confusion. Things got added and removed and then added back and then removed again. So when the final 1,000-page bill got passed, obviously a lot of people didn't have the time to read it all the way through. So at first, we didn't know exactly what was in there and what wasn't. So there were news reports, and the Social Security Administration also released a statement that Social Security benefits were no longer taxable, but that just wasn't in the bill. It's not true. So there's a lot of people that are like, oh, great, my Social Security benefits, I don't have to pay tax on that anymore. Unfortunately, that's not true. So remains unchanged. Up to 85% of your Social Security benefits remain includable in your taxable income. There was what's called the senior deduction added for taxpayers 65 plus. We'll talk about that later. That was added to help reduce some of that income for those in the Social Security age, but the actual taxation of Social Security benefits remains unchanged. Okay, so two of the biggest changes under the TCJA from that 1986 law were the tax brackets and the standard deduction. You can see right here on the screen, we have on the right, the tax brackets from 2016. That's the last, those are the last buckets under that old law. And then we have the 2025 tax brackets on the left side of the screen. As you can see, under the TCJA, we removed that top bracket of 39.6%. Now the highest bracket is 37%. So under this new law, OB3, this is now a permanent change. So if nothing had passed, we would revert back and that 39.6% would be the highest tax bracket. The other thing that changed within these brackets is that they're wider, meaning that at these lower rates, more income is included. So how your income is taxed is it's not, okay, well, you make, let's say on the married filing jointly 37%, you make $800,000. That's going to put you in the 37% bracket. That doesn't mean all of your income is taxed at 37%. You're going to flow through these buckets in that amount of income. So any income at married filing jointly between $23,851 and $96,950 is taxed at 12%, and then that next bucket is all taxed at 22%. So in theory, because those buckets are wider, you're going to be paying less tax overall because you have more income included in these different buckets. For instance, if you're married filing jointly and you had ordinary income of $350,000, under the old law, that would fall in the 33% bucket. Now, under the new, well, the TCJA, but now made permanent OB3, you would fall in the 24% bucket. So what this means is lower overall tax rate for the similar amount of income. Standard deduction. As you guys may recall, the standard deduction is the deduction everybody is entitled to against your income. So under the old law, it was $6,300 for individuals, and for those married filing jointly, it's $12,600. And pretty much it's doubled under the TCJA and now made permanent under OB3, meaning those married filing jointly would get $30,000 deduction on their income. So as you know, standard deduction versus itemized deduction, you only get one of those. So itemized deductions, there's some examples included on the screen. Those are medical expenses, state and local tax, charitable contributions, mortgage interest, and a couple other items. You can calculate the sum of all of those. And if those are more than that $30,000 standard deduction, you take that deduction. So for instance, if all of those items added up for you are $40,000, you would take the itemized deduction instead of taking the $30,000 standard deduction. But if all of those items add up to $15,000, you're going to take the standard deduction of $30,000 because that's the minimum deduction everybody would receive. So this is really helpful for a lot of taxpayers for two different reasons. You do get the higher deduction, so pretty much everybody is entitled to at least double what it used to be. And then it does help streamline your tax return. Under the old law, around 30% of taxpayers took the itemized deduction. Now under this new TCJA and OB3, around 11% of taxpayers itemize. So that just streamlines your tax return, makes the tax preparation costs for your CPA less. You don't have to keep track of your receipts or your property tax statement or your mortgage interest statement. Just streamlines the whole process and simplifies the return. Like Sarah said, a lot of this bill is making permanent the TCJA. There were some additional changes on top of that, and we picked some out to go through together. Obviously, there's more outside of these items, but these are the big ones we thought would affect your tax situation. So as we were discussing earlier, those itemized deductions, one of the buckets inside of that is state and local tax. We call it SALT. That was capped at $10,000. So your property taxes and your Georgia withholding and your ad valorem taxes from where you renew your tag all added up to $15,000. You were capped at $10,000. Now that cap is up to $40,000 for most taxpayers. This does start to phase out at $500,000 $500,000 of income and is completely gone for $600,000 of income and above. This is both for individual and married taxpayers. It's $500,000 and $600,000 for both. And if you fall and it's over that $600,000, you revert back to that $10,000 cap. This is not a permanent change. This is set to what we call sunset, means it goes away in tax year 2030 unless there's it's extended through 2030 and beyond. So what this means is that taxpayers can get a higher deduction, and this might help you have more itemized deductions. Something else that's new under the bill is called a Trump account. So what this is for children born between January 2025 and right now is set to end at December 31st, 2028. The government is going to put $1,000 in a tax deferred account for them. Also, what is allowed is for you as a parent to contribute $5,000 of after-tax income every single year until they turn 18. This is similar to an IRA where it's not taxed on its earnings now, it's taxed when you pull the money out. Once the child turns 18, there are some qualified uses they can distribute out from the account for. That is for first-time home buy, birth and adoption expenses, and education expenses. Outside of those, what they called qualified uses, the account cannot be touched until they turn age 59 and a half. And then if you do distribute early, you get that 10% early withdrawal penalty, similar to an IRA. We don't really know what this is going to look like. There's not a lot of guidance involved, but we do know that this will start in 2026. They'll start funding these accounts. So we expect more information to come and more guidance from us as BIP of how to, the mechanisms of this account and if you should contribute or not. A couple of additional changes. We discussed that $6,000 deduction. It's called the senior deduction for taxpayers 65 and above. This is $6,000 per taxpayer who is over 65. So if you're 65 as a spouse, you get the deduction, but if your other spouse is 62, you only get $6,000. But if you're both over 65, you would get $12,000. This does start to phase out between $150,000 and $250,000, and this is expected to go away at the end of 2028 unless it's extended by the government. A big thing here is that in these tax years of 65 and before you are eligible to take required minimum distributions from your IRA, your income tends to dip, and we might, as a firm, encourage you to do Roth conversions. This is kind of throwing a wrench into that plan because we don't want to push you over that income threshold to get rid of that $12,000. So that's all embedded in our software, but it's an additional consideration when messing with those lower tax buckets. Another item is for 529 plans. A lot of y'all might have those for your children for their education expenses. So they've increased the allowed distributions for those, mostly being around standardized tests and tutoring, as well as professional exams and any like study materials for those, such as the CPA, CFA, bar exam, those kind of professional licenses that now can be used. 529 funds can be used for that. Another big one that starts in 2026 is that you can now take $20,000 for private school tuition from K through 12. The old limit was $10,000, so it's doubled. So you're allowed to use more of those funds towards private school. Another item for some taxpayers who might be restaurant workers or hairstylists, you can now exclude up to $25,000 of overtime and tips. It only goes through the 2028 tax year as well, unless it is extended. The big thing here with overtime, it's not all of your overtime. So if you work 45 hours, that whole 5 hours isn't excludable from income. It's just the half of time and a half. So the time The base rate for those 5 hours is still taxable, but the half in addition could be excludable from income. So some other changes to itemized deductions, right? We talked about standard deductions, itemized deductions. The charitable contribution deduction, you guys might have seen this in 2020, 2021. It's similar to that, where you can take charitable contributions up to a limit and take the standard deduction. So say you get the $30,000 standard, you can take up to $2,000 as a charitable contribution, assuming you gave the $2,000. This allows for a little bit more of a deduction for charitable purposes and still take the standard. The other big one is there's now what we've been calling a floor or a haircut to charitable contributions. So there's now a 0.5% of AGI. AGI is what's your adjusted gross income, so just think net income. So if a taxpayer makes $100,000 of AGI, the first 0.5% of that income is not allowed to be taken as a charitable contribution. So think $100,000, 0.5% would be $500. So that first $500 of your charitable is disallowed. So if you gave in that situation $2,000, $500 not deductible, so the remaining $1,500 would be allowed to be taken as a charitable contribution. This is some planning considerations around this would be what we call bunching charitable contributions. So if you guys have a donor advised fund, we might advise you to contribute to that every 5 years. So preload 5 years worth of charitable, let the other 4 years you don't give to charity, and then 5 years later, you give to charity again, get that deduction. That way that haircut isn't taken every single year off of your charitable contributions. The other big change is to our taxpayers who are in that 37% tax bucket. You might remember that's the highest one. You no longer are going to get the full benefit of your itemized deductions. There's a whole formula involved, but in theory, that tax is going to be removed at 35%. So you're losing 2% of your itemized deductions off the top. Like I said, our software is updated for all of these changes, so we can have planning conversations around these, but I did want to make you guys aware of those changes. So now we're going to move into a couple of business items. A big change, it's really just made permanent, is what's called bonus depreciation. You guys might have heard of depreciation before. That's if, as a business owner, you buy a piece of equipment, so you buy it for $10,000, you have to depreciate it over its useful life, meaning you take an expense on your tax return every single year of its useful life until you reach that full cost. So piece of equipment has a 5-year useful life. It costs $10,000. You buy that piece of equipment this year for $10,000. You can take $2,000 deduction for 5 years until you hit that full $10,000. Bonus depreciation allows you to take that expense all in the year of purchase. So this means in this scenario, you buy that equipment for $10,000, you get a deduction on your tax return in that year for $10,000. Important note here is this cannot be used for real property, so buildings and improvements. It's only for things like equipment, computers, printers, furniture and fixtures, things that are more tangible and movable. You can take that depreciation in the initial year. So this allows business owners for their expenses to better match on their tax return to the actual cash flow. A big item that might not affect a lot of you guys personally, but could affect indirectly would be this 1202 exclusion. So this is for qualified small business stock, which is certain small C Corp owners who sell their stock could be entitled to a $15 million gain exclusion. We don't need to get into the weeds of this on this call, but it went from 10 million to 15 million, so it is increased. Under the old law, it was a 5-year holding requirement, meaning if the company or the business owner sold that stock in 4 years, they missed out on the whole exclusion because it had to be 5 years or greater. Now there's a ramp up. So at 3 years, you could be eligible for 50% gain exclusion, 4 years, 75% gain exclusion, and we increased that exclusion by $5 million. The big thing here is a lot of our private investment funds, a lot of the companies within those funds here at BIP could qualify for this exclusion. We've had a lot qualify in the past. So by making it easier for them to get a larger and quicker exclusion, this could affect you on your BIP K1s, meaning you could pay potentially less in long-term capital gain on any exits in those funds.
There's also an estate planning element to the what we call the QSBS exclusion that I'll comment on real briefly. And essentially it's that, let's say we have business owner founder who is ready to sell his business. He's held it for the requisite, or she has held it for the requisite period of time, is ready to sell, but this business has just exploded and it's going to be 45 million worth of gain. The idea is that the $15 million exclusion applies per taxpayer. So the estate planning strategy can be to set up multiple trusts that are treated as separate taxpayers and put a piece of the business in each trust. And so now you've got the owner founder plus their two trusts, that's 15 million times 3, that's $45 million worth of exclusion. So some incredibly impactful planning. It's highly technical. If it's too good to be true or sounds too good to be true, it probably is. So not necessarily that, but a lot of coordination goes into that. It's not for everyone, but I think something worth mentioning for the benefit of those business owner clients.
Okay, now we're going to kick it to Bill for some questions.
Great job, Sarah and Allie. As all of you can see, they are both fantastic additions to our firm as we continue to bring more resources to our clients. The Q&A section there on the toolbar, there's a Q&A button, and you click on that and type in questions. We have plenty of time to go through some of these questions. So I'll start with the first one here from Anonymous. Do I need to update my estate plan as a result of these changes, Ms. Sarah?
Yeah, I have a great attorney answer, which is it depends. It depends, maybe not. The older the plan is, the more likely it is that updates are in order for these reasons, but a whole host of others. A rule of thumb when I was in practice, and I still think makes sense, was at least put your eyes on your plan every 2 or 3 years, which sounds kind of crazy, but things change, laws change, people change, your family situation changes. So good to review, and kind of like we alluded to before, if there's any question whatsoever regarding whether it's time to make a change, just have your wealth advisor loop us in.
This next one is from Loring. Should we expect more major tax reform in the future, Allie?
Short answer is yes, I would imagine. Going from 1986 to 2017 without a major tax change is a long time. So I would expect maybe not in the next 4 years, maybe not in the next 8 years, but taxes are political. So different sides have different control of the situation. So we could definitely see more reform in the future, but we do not have a crystal ball. So we don't know what that's going to look like.
Deal. I have a follow-up question for you, Allie, regarding capital gains. So from Mitchell, are there any changes to the capital gains rates?
No, those remain unchanged. Obviously, those have different buckets as well, similar to ordinary income. Those do change every year with inflation, but no significant change.
All right. Next one is from Ken. Does the 0.5% AGI floor for charitable contributions apply to both standard and itemized deduction filers, or just for the itemized deduction filers?
Yeah, so the itemized deduction filers do get that 0.5%, we call it haircut, but the standard deduction, as we discussed, you get that $2,000, assuming you gave $2,000, it's $2,000 free and clear. Great question.
Deal. Thank you, Allie. Next one from Ari. So, Allie, can you please elaborate on the pitfalls of when you do a Roth conversion, why that way may be a negative for someone who's 65 or older?
Yeah, and thanks, Eris, for the question. So the 65 and older deduction, the senior deduction, the theory there is there's that phase out range. So if we don't want the benefit of the Roth conversion, so taking money from traditional IRA to Roth, that is a taxable event, creates taxable income. We don't want that income to push you out of taking that senior deduction. I mean, it's a case-by-case basis. There are situations where the tax savings in the long run would eclipse that $12,000 deduction, but it's just a tool, an added layer of complexity in considering for the Roth conversion that we are aware of, because we don't want to reduce that $12,000 deduction and make you lose out on that when it would make more sense to not do the Roth conversion. So it's just a case-by-case situation.
Great. Okay, next one is for Sarah. Next question. Is the $30 million cap total for all gifting or transfers or limit for each individual you gift or transfer to?
I wish it was for each individual we transfer to, but unfortunately that's total. So that kind of gets confusing because the floor we talked about, the annual exclusion, that's per person. I could give $19,000 to 100 people and there would be no transfer tax implications. But the lifetime exemption, it's also referred to technically as the unified credit. Unified meaning it's all I have during life or at death. So if I used $7.5 million during my life, then I would have $7.5 million left at my death. That's for an individual. And then 30 million would be if I was considering, my spouse and I gifting or transferring at death together. So it's just one set cap, which in one way makes it easy, but it's also made difficult because of the uncertainties of, will this remain permanent? What will it look like in X number of years? And what will my family's net worth look like in X number of years? Those are kind of the big variables. And we can use some of our estate planning software, like Allie has the income tax planning software, to incorporate the financial plan and make these, projections and just kind of see how exposed or not we are.
Yeah, this next question is for both of you. So Sarah, I'll let you answer first, but how is BIP incorporating these changes in tax planning for clients, like with the estate plan review? And then Allie will ask you about tax projections.
Yeah, so usually when I'm working with wealth advisors, clients here at BIP, the first thing I do is review their personal financial statement, their net worth statement, their financial plan, and their existing estate planning documents. And this, I've got a whole laundry list of items that I want to see. Of course, we're looking at, was this executed in 2001? Was this executed before the Secure Act in 2017? There's been a lot of other legislative changes we're not even talking about today. But really, it's starting with that analysis and then sitting down with the individuals or the families and going through that and highlighting what in particular we need to address or, we might want to change, and then making recommendations to an attorney in private practice to help with those changes.
Yeah, and from a tax side, I know we've said this a couple of times, but our software we use is called Holistiplan. It's already updated with these changes, or from their interpretation of these changes. Obviously, we won't know exactly until the IRS issues guidance. But we've already updated, so any scenarios run since that July 4th signature date is with the updated tax law. So it's something we've done a lot of planning around in meetings in the past month and a half. A lot of strategy around charitable contributions, I would say, is the most heavy-hitting item with that new floor, and then the 37% reduction for itemized deductions. So we're already having those conversations. Our software already is up to date. So please reach out if you have any questions specifically, and we can look at your situation, how these new rules will affect you.
the next one coming from the Crapchos. So nice job, Sarah and Allie. Are there any new laws that have impacts to the use of ongoing management of revocable or irrevocable trusts? Sarah?
Sure. Yeah, a few things come to mind that have been pretty major. One was the Secure Act. So the Secure Act, I think if I'm remembering correctly, was enacted in 2020. So it's been about 5 years. The Secure Act really fundamentally changed what happens with retirement accounts when the owner passes away. So we're talking about IRAs and 401ks. So that in itself isn't directly trust related, but there's this whole body of law of how trusts and retirement accounts interact. So for example, my estate plan includes trusts for my children because they're minors and they can't inherit, or I don't want them to inherit assets outright. Also, we have a lot of our savings in retirement accounts, and the Secure Act just really fundamentally changed how those work together and what provisions should be in the trust to make sure we have the best outcome possible. So when I'm doing my document review at BIP, that's one of the major items on my checklist was this pre or post Secure Act? And if it was pre, is there anything in that trust language that's going to impact the taxability of retirement accounts for the beneficiaries? At the state level, we've had some kind of major updates to the trust code. It's been a while. I think the last one passed in 2017 and was enacted or became law in 2018. There was a major trust law change in 2020. A lot of the trust mechanisms of how they're administered are governed under state law. So the Georgia code updates can be really relevant there. So it's just one of the many, many reasons that, the longer it's been since you took a look at your plan, the more likely it is that it has grown somewhat stale and some updates might be in order. Our goal is always to be as tax efficient as possible. Like, we don't want to spend extra on taxes, and to be just as efficient as possible in terms of making it easy to manage these things.
And from a tax side, so we discussed at the beginning those tax brackets that were made permanent under OB3. They changed under TCJA, made permanent under OB3. The same thing with trusts. Their tax brackets were updated and made permanent under OB3. So those are carrying forward. They're not reverting back. Sarah and I work really closely on irrevocable trust and when it makes sense to kick money out to the beneficiaries, or when it makes sense to pay the tax within the trust. So not necessarily anything new, but just making everything permanent. Some of the state and local changes for taxes, that 40% cap does carry forward to trust as well. But nothing crazy new there, but just know that me and Sarah do work closely on trust to make sure everything is most tax efficient as possible.
Good points, Allie. Sarah, nice job. Next question from David. Is there a way to figure out how much to move to a Roth IRA while staying in a 12% bracket? What sort of tools do you have available to you, Allie, to help a client figure out how much to move in a Roth conversion to stay in that 12% bracket?
That's a funny question, because this is the bread and butter of what most of my meetings are here at BIP, is this taking advantage of that. Okay, I've retired, but I haven't hit the required minimum distribution age yet. So taking advantage of that 12%, that 24% bracket. So what we do is we have a software, we've referenced it earlier, Holistaplan, and it allows us to update all your information. So say we want to run it for 2025, we can update for all your interest and dividends and capital gains. And then we can see how much room is left in that 12% bucket, in that 24% bucket, and see how much Roth conversion we can add without crossing over into that next bracket. So also another wrench in that, the senior deduction, that's also included in the calculation. So we can kind of tweak that number to see what makes sense for your personal situation.
And as a follow-up to that, Allie, how do the QCDs or qualified charitable deductions
So great question. So now with QCDs, so for those who don't know, QCDs are qualified charitable distributions. So that's when you take money from your IRA and it goes directly to a charitable organization. This is allowed when you're 71 or older. So what this does is it doesn't run through itemized deductions. It's not a charitable contribution. You can do this even if you have the standard deduction, and it reduces that taxable amount on what we call the top line. So like that adjusted gross income would be reduced by that charitable deduction. The big planning here is that that does not get hit with the 0.5% haircut. It also is beneficial because it could help reduce your Medicare premiums. So that's a big planning strategy as well that we can include in any projection.
Yeah, thank you, Allie. And David, you mentioned in one of your questions about scheduling a meeting with Allie and also bringing in your personal wealth advisor, Taylor. So highly encourage you to do that. And we want to make sure you've got the right plan in place for the next, 5, 7, 10 years as you continue to work through the retirement year. So that's a great question. Thank you, David. The last question we have, any guess to what percentage of families are subject to the estate tax now versus a much higher percentage back in 2001?
No, the answer was no. I have no idea. But while Allie was talking, I Googled it. So according to the taxpolicycenter.org, I'm hoping that this is accurate because I'm going to say it out loud. It says that, and it's citing IRS, Internal Revenue Service statistics and tables. It says there were 50,000 taxable returns filed in 2001. So 50,000 or so individuals or estates had to file an estate tax return. In 2023, so this is a couple years old, it was 4,000. So, it's a very small number of individuals who actually file estate tax returns. If you are under the threshold, unless you're electing portability, you don't have to file. So it's in the individual thousands versus 50 that many years ago.
It's great. Thank you, Sarah. And that exhausts the questions for today. And I'm so thankful that we had so many people attend this presentation. I thought Sarah and Allie did a fantastic job. And thank you, everyone, for attending. And please reach out to your personal wealth advisor if you have any questions, or if there's anything we can do for you, scheduling a meeting with Sarah and or Allie, that would be great. So we're here to take care of you. Thanks so much and enjoy the rest of your day.